What's up, everyone? We're live. Let me know in the chat if you can hear me. I think audio is okay. Let me pull up the chat here so that I don't miss any of your questions, and let's get right into it. So on today's video, we're primarily going to be talking about SoFi stock. I know a lot of people are interested in this company. I personally own some leap options, some call options that are in the money that won't expire to 2024. I've been following this stock, and there's a lot to talk about because today, well, it wasn't a good day. The stock dropped a lot. We're going to go over that in today's video. But to start off, we're actually not going to be talking about SoFi stock. We're going to have to talk about Lending Club and the impacts that's having on SoFi stock because Lending Club really dropped. So to get started, let's just head on over to Thinkorswim, and I actually want to show you what happened with Lending Club. So here is the chart, and as you can see today, the stock dropped 29.24%, a massive drop. This is the biggest drop in Lending Club stock since May of 2016, which is so far back you can't even see it in this chart. You have to go to the max available to see that kind of drop. And back in May 2016, that's right here where we saw that big drop from around $40 to a low of $17.50. So a big drop. But why did Lending Club drop so much? It's because of earnings. Quarter four wasn't bad. They actually beat estimates in revenue for quarter four, but they came in lower for Q1 in guidance. And guidance is what matters most when it comes to stocks because the stock market prices stocks for what they're going to do in the future. And guidance is a projection of what they're going to do in the following quarter. And if guidance comes in lower than estimates and doesn't beat expectations, stocks typically fall. Let me get that chat back up there. If you guys have any questions, let me know in the chat section. Thank you so much. Viva la raza. ¿Qué pasa, amigo? Hola, mi gente. ¿Cómo anda? I love hearing from all of you. You guys support me, and I appreciate it 100%. All right, so let's get back into it. So Lending Club, where I left off is the fact that the stock dropped off of guidance, but it's really not that bad. If we take a look at what Lending Club did, we can see, or actually, there's a better way to look at this. If we take a look at the news and if we take a look at this article right here, we can see what Lending Club did. So on Wednesday after hours, the company reported quarter four diluted EPS of 27 cents a share compared with a loss of 29 cents a share last year. So their positive EPS, they actually posted a profit. Revenue rose to $26.2 million from $75.5 million. So a huge increase in revenue because a massive surge in lending. Lending is seeing this surge because rates are low and people are taking advantage of it as they should. I personally refinanced on my own. A lot of people that I know that own real estate, they refinance because rates were so low. It's just the best time to do it. And actually, there's more benefits than just lowering your rate. You can cut out PMI, reduce your monthly cost for your home, for your mortgage. And I just realized that Anthony Noto pushed back earnings to March. I did not know that. Thank you, Wancho from SoFi. I appreciate that information. We're going to dive into a little bit of SoFi's prior earnings and talk about it. But the issue with Lending Club wasn't their quarter four earnings, it was their guidance. So Lending Club said it expects revenue of $255 million to $265 million for quarter one and $1.1 billion to $1.2 billion for the full year, for the full fiscal year of 2022. The estimates were $262.3 million and $1.15. So guidance for the full fiscal year came around, we have that range, which is slightly lower than estimates, but if they come in at the high range, they're beating estimates. And for revenue, if they come in at the high range of $265 million for quarter one, they're right at estimates, but if they come in on the lower end, they're below estimates. Now, it's not a huge difference. And for the stock to drop more than 29% off of this news, I think is a little bit of an over sell off. People are overreacting to this news, in my personal opinion. But I'm not going to buy Lending Club because I don't want to have exposure to Lending Club, to SoFi. And also, I think this reaction, I think people are afraid of what's going to happen to lending moving forward. Are we going to see that kind of growth when we see an increase in rates and people are less likely to take loans, less likely to refinance on their mortgages, less likely because they already did it, and people don't refinance multiple times. Usually it's a one and done, maybe 2 times for the entire life of the mortgage. So this reaction was a very, very steep drop off. Sell off was huge in Lending Club. So we're really talking about lending and the impacts that we could see in lending moving forward for all lenders. And SoFi is a company that lends a lot. So if we take a look at Q3 earnings for SoFi, and this is where things get interesting, and this is where we need to be careful with SoFi. So if you're invested in SoFi or you're looking to invest in SoFi, you know that SoFi is trying to be a company that provides all kinds of financial services. Basically, they're trying to create a flywheel of financial services. In that flywheel, you're going to be able to lend with them. You're going to be able to put money in checking and savings accounts. You can invest, you can trade stocks, you can invest in crypto. You can do so many things within SoFi. They're trying to create that flywheel so that you never have to leave their platform for any of your financial services. So lending is one portion of SoFi's business, but there are other aspects to it. And right now, lending is the vast majority of their business. Let's take a look at it. So if you take a look at Q3 earnings for this company, because Q4 has not been released yet, and according to the chat, it will be released in March. But if we take a look at the earnings for this company, we got to go to their financial statements, and here are your segment financials. Actually, let me back up a second. If we take a look at If we take a look at 2021 guidance, which is, I think they're going to come in at the higher end. 2021 guidance is around $1 billion in annual revenue. So keep that number in mind. If we take a look at the segment financials, and what we're going to look at is the last 12 months. So basically the full year of 2021. What you're looking at here is you have lending, and that's broken into student loan originations, personal loan originations, and home loan originations. The adjusted net revenue for all of that was $715 million. For Q3 of 2021 was $215 million. The other services that we have are your technology platform. That comes in for Q3 of 2021 at $50 million. For the last 12 months of $178 million. And the other segment that we have are the financial services. These are your 3 segments of revenue for SoFi. Financial services came in at $12.6 million in the Q3 of 2021 and $40 million for the full year of 2021 for the last 12 months. So we have $215 million in Q3. Q3 revenue came in at $277. So $215 million divided by $277 million, lending takes up 77% of SoFi's net revenue right now. This number should drop in the future, but right now, SoFi is very dependent on their lending. And that is a huge risk moving forward because of what's going to happen with lending as rates rise. Now, one thing with SoFi that I think they are the leader and there is some upside and we can surprise with their lending segment is if you take a look at this and you take a look at their segment financials and you look at their student loan originations, you can see that the student loan originations back in 2019 was the vast majority of their business. In fiscal year 2020, it was still a really good portion of their business until quarter two, when we got hit with the pandemic and student loan pause. Since then, we have been lacking in student loan originations. If you take a look at the full year, this is a good picture. You can see that student loan originations were 6.5 million in 2018, 6.7 million in 2019, 4.9 million in 2020. And in the latest 12 months, 3.8 million. The originations or the student loan pause is going to end come May. We should see a boost unless it's extended. That boost will help earnings and hopefully help SoFi surprise to the upside. But it's a huge wild card. We don't know when this pause is actually going to end. Let me take a look at the chat real quick. Not much going on, so we will continue. Let me drink some beer. Cheers, my friends. But anyways, when you take a look at SoFi and you take a look at the stock, it's trading at a market cap of $9 billion. For this fiscal year, we're estimating around $1 billion in revenue. So a price to sales multiple for the trailing 12 months is around 9. If we assume that they're going to have 40% increase in revenue growth, they're having around 60% right now. That's going to put revenue at around $1.4 billion. Maybe they hit $1.5 billion. And then you're looking at a price to sales multiple of around 6 forward looking. For a company that is growing revenue at around 60 to 40%, a 6 price to sales multiple isn't outrageous. And actually, we could see an increase in the stock because of valuation. And that's one reason why I do like SoFi. However, there is a caveat to that. You know, right now in the stock market, companies that are not profitable today are getting slammed. And that's one reason why we are seeing so much weakness in SoFi stock right now. They trade at a price to sales multiple and not a price to earnings multiple. And that does matter in this climate. Bank charter, as mentioned, will help with profitability. We're looking at around $200 to $300 million increase in adjusted EBITDA based off of the bank charter. That will be in effect for the next coming year in 2022. For this year in 2022, probably in quarter 2 or quarter 3 of this fiscal year, you're going to see that increase in profitability because of the banking charter. And that's why that banking charter is huge. So SoFi's fair price as of today, we did a valuation on it, and based on the revenues that we have around $1 billion and the fact that we're trading at a price to sales multiple under 10 with good revenue growth, it's at fair value right now and it's worth nibbling. But it's not a stock that is just absolutely going to be a 100% lock in gains. We could see more volatility. We could see more downside in SoFi stock. And it's the risk of the lending and how the market is going to portray SoFi if they're going to give them credit for the other services, even though right now lending is the biggest portion of this business. So for me personally, it's a stock that I'm holding, but it's not a huge position of mine. And what I think are the upcoming catalysts, and we're going to talk about the banking charter catalyst when we head to the charts. The next upcoming catalyst for SoFi is obviously the Super Bowl. We'll see what kind of reaction we get from that. Then we also have the next catalyst after that is when the market starts to cool down a little bit and analysts are a little bit more comfortable creating new price targets for stocks. I think we're going to see a lot of good price targets for SoFi because of that banking charter. We didn't really have many re-ratings when we got that approval because analysts right now, in my personal opinion, do not want to be given price targets while we're seeing this huge correction. They're going to wait for volatility to die down a little bit when they start actually giving out more price targets. That's my opinion, at least. So those are two catalysts. And then the third catalyst will be once that student loan pause ends and we get a little bit more clarity on that, that's going to be really good for SoFi. So you got three catalysts still for this stock. We got the banking charter. We saw a pop, but the whole gains did not hold. And we're actually trading at a lower price today than before the banking charter, which is crazy. And actually, what I want to talk about that, what I want to say about that is that there are traders that were in SoFi because of the banking charter. When we got that news and we saw that initial pop, which wasn't anything crazy, I think some traders sold out. When we broke down and we got back to the prior levels before that banking charter news, I think other people left as well, thinking, well, that was the pop. That's it. What's next for SoFi? Do I really want to be in this stock? And they sold. And that's why, in my personal opinion, we're at a price now that is lower than before the banking charter because a lot of traders exited, left the stock because that catalyst was over. They didn't get the returns they wanted, so they fled. That's what I think is happening right now with SoFi in combination with weakness in tech and Nasdaq. So let's head on over. Before we head on over to the charts, there are two things that I want to show you guys. Insider trading. There was one sale because I've been showing you guys this on my channel. There was one sale. 2,000 shares were sold by head of operations for $30,000, but they own 128,000 shares. So this was a very small sale. But I just want to let you guys know that there was some insider selling with SoFi stock. We also got a round of 13Fs, which are institutional holdings. And we can see that there is a fair amount of institutional ownership in SoFi. And a lot of them actually increased their position in Q4. So when you take a look at some of these institutional holders, and right now it's sorted by value. So the largest position is Russell Investments Group at 21 million. And that's a 73.47% increase from Q3 of 2021. But it's a small position. It's around 0.03% of their portfolio. If we sort this by portfolio percentage, Belmont Capital, which owns 242 shares worth $3.8 million, or 3% of their portfolio, they actually sold some. They decreased by 38%. But this Vigilary Wealth Management, they increased 6.53%. It's a 1% weighting at 1.7%. But nevertheless, when we take a look at what's happening with SoFi, there have been a decent amount of new positions in Q4 of 2021 by institutional ownership, which is a good thing. And we are seeing more institutions pile into SoFi. So I think some people are looking at this as a potential long-term investment or get some exposures to fintech because fintech has sold off so much. That's my opinion, at least. Let's head on over to the charts. So when we take a look at SoFi, Lending Club dropped 30%. SoFi dropped 9.7%. But the bigger thing here to take a look at is on Monday, we saw the Nasdaq drop 4.5%, a huge red day in the Nasdaq. And that set a low for a lot of stocks. That is right here at around $11.90 or $11.85. We obviously today broke below that. And then after that broke, we did see a gap down, or it sell off even more to 11.2. So right now, SoFi is trading at a low value. If you take a look at the 1 year, 1 day, we are pretty low on the charts. And this is actually quite ironic. And then the sell off, and that was a buy the rumor, sell the news type of event, even though if you were investing in SoFi for a long-term investment, that banking charter is crucial for the fundamentals. It's crucial for profitability, and it's crucial for SoFi building out to a better company that can offer you better financial products and services and just be a better company altogether, a more profitable company. So in my opinion, once we see volatility kind of die down, we will see higher price targets for SoFi, or analysts will reiterate a buy rating or overweight rating for SoFi based on that banking charter and based on student loan originations if we get some good news on that front. That's my opinion, at least. If you're talking to me and you're asking me what's a realistic price that SoFi can get to if things work out well this year, I think we can easily head back to that $20 range. I think we're probably going to top out around $25 in this year, and that is where I think the potential lies. If things do not go well and guidance is lower and lending is taking a hit because of the rise in rates and the student loan originations get extended, or even worse, there is some bill that gets passed in Congress or some form of stimulus that forgives or completely wipes out the prior student loans, then this stock can head much lower because it is trading on a price to sales multiple. So there is a lot of potential reward, but if things don't go right, there is a lot of risk as well with SoFi. This is a high-flying stock with a lot of volatility, and that risk needs to be properly accounted for in your portfolio. Your allocation needs to match that risk. Whatever you're comfortable with is what you should invest in SoFi. Then if we take a look, so SoFi broke those lows, and that's not a good thing, because if we take a look at the actual Nasdaq, and we're going to take a look at the futures because we are in after hours trading. If we take a look at the futures had a low of 13,950, but if we zoom out to the 5-day, 5-month, or 5-minute, we can see that the low was 13,706. So the Nasdaq did not take out the prior low, but SoFi did, and I think a lot of this has to do with what happened with Lending Club. So Gross Steer makes a good point. They don't make any money now. They're not profitable. They trade on a price to sales multiple. You only want a few of these kinds of stocks in your portfolio. The market right now is hammering those kinds of stocks. So I personally invest in companies for the long term. Some of the companies that I have money in are not profitable today, but will be in the future. So if you have a long-term outlook on a stock, it's okay to get into some companies that are not profitable today if you truly believe they're going to be profitable in the future, but your risk allocation has to be appropriate for that, especially in this climate where earnings matter, where companies that are not profitable and trading on a price to sales multiple are getting hit hard. You're going against the grain by investing in SoFi right now. It's not the momentum trade. It's not the trendy trade. It's a investment, in my opinion. Now, we're talking about Robinhood in the chat. Robinhood was a company that I did a video on a month ago when the stock was trading at $20. Let's go back. So 30 days, 1 hour. Stock was trading at $19.90 when I did my video on Robinhood. I released it a month ago, and I said that this stock would be cut in half before you should even consider getting into a position. The stock today, now in after hours, is trading at, it hit a low of $9.77 and is currently trading at $10.12. This stock, do not buy. I think it's going to head even lower. The earnings were abysmal. There is no clear trajectory of strong growth. The comps are going to be extremely difficult to compare against, because if you take a look at January of 2020, that's when we were dealing with the meme stock mania and so many people were piling into Robinhood, and that's going to be so hard to compete against. So their comps are going to look awful. You're comparing revenues this quarter or growth this quarter to the growth that you had in the prior year, which was an outrageous year, a crazy year, a bubble of a stock market, so many people piling in, it's going to be very hard to compete against. And investors are going to have a very hard time trying to understand where growth will come from, how Robinhood is going to grow. That's not true for SoFi. We know how they're going to grow. Their banking charter and their financial services, creating that flywheel. It's easy to understand. If I can understand it, you can understand it. It doesn't take a genius to understand the route SoFi is trying to take. It's just a matter if they can get the members, and they're doing a really good job of gaining members. They're spending a ton in marketing. That's hurting profitability, but that's in spend that you hope is only going to be front loaded. And once they start getting members in, those members will use almost all of their services, or there's so many options for them that they don't ever have to leave the platform. That's the goal. That's what SoFi is trying to achieve. If you believe in the management, which I think Anthony Noto is a great CEO, then it's a good bet to take. But yet again, I'm going to be very clear. I'm not a financial advisor. I'm not telling you what to do. And I'm also saying, for me personally, there's risk here. You just have to properly allocate to that risk. I'm going to get into some of the chat. So let's take a look at this. Let me scroll up a little bit. So Wancho from SoFi. SoFi should be $20 to $22 or 20 to. I'm assuming you're saying $20 in 2022 or $20 to $22. Thank you for that clarification. I agree. I think 20 to 25 is realistic. The government can't cancel private debt. They would have to pay SoFi the loan amounts. Yeah, it's not like SoFi is going to take a loss in those. It's just it's going to slow growth and refinancing. If they're going to cancel student loan debts and you have a student loan debt that you haven't refinanced, you're not going to refinance. So it hurts with the growth in that originations. Robinhood went single digits. Yes, they did. Wancho, I own PayPal. They're profitable and they're down like 60% from the top. Same. I also own PayPal. I think PayPal is one of those legacy companies that will do well and will rebound, but the valuation is a little stretched there too, and that stock is being sold off. The whole sector is being sold off. But overall, I think being profitable does matter. PayPal is an example how it's still stocks are still falling, but the vast majority, if you take a look at stocks that trade at price to sales multiple, they're getting hit worse than stocks that have earnings. From all the ones which are not profitable at the moment, which ones are your 5 favorites? So obviously SoFi is one of my favorites that's not profitable. Uber is another company that is not truly profitable. They don't have a positive net income, but they're getting positive adjusted EBITDA. I do like them as well. Looking at Chewy's another company that is barely profitable. The last quarters they weren't because of supply chain and inflation. That's another company. And then I'll throw you some wild cards out there, some stocks that are trading at like $2. There's this SPAC that went public, Owlet. They are at around $1.70 right now. That's a company that I like. And also another company, barely any revenue. Let's just say no revenues at all. And that's Black Sky. Those are 5 companies that are not profitable that I think you can throw some money in, but I would not expect a return anytime soon. Those are long-term investments for me. And Owlet and Black Sky, I barely have anything in. It's so small. I'm just adding a little bit and a little bit every single week, essentially. Do you think Nasdaq will go south more? So what we're seeing in the Nasdaq, I don't. This is a very hard question. We've seen the Nasdaq hit that low of $13,700, It's bounced 1, 2, 3 times here, and it held here again. I think we're going to find out whether or not it's going to head further down tomorrow or Monday, maybe Tuesday. In the next, let's just say in the next week, we're going to get our answer because we're basically at the lows. Now, my opinion with Apple having good earnings and moving higher, with Microsoft having good earnings and moving higher, I think mega cap tech, given this sell-off that we've seen in those stocks, and they are doing well in their earnings, I think they're going to be just fine, and they're going to create a situation where the Nasdaq can hold this support. So I don't think we're going to be heading lower, but there is a case that we can. Let's just put it this way. I don't think we're going to be heading lower, but I don't have high conviction on that. I really don't know what's going to happen. This is very hard to predict, and I just came to the conclusion that I can't predict this. So if we head lower, I have cash available to buy. If we head higher, I bought the dip here, and I'm happy. I don't know what's going to happen. Nobody really does. Let's go back to the chat. Advantage about SoFi is the bank charter will help us to be profitable faster. Correct. $200, $300 million in adjusted EBITDA increase. Another 10 to 20% in my opinion. Jose, 10 to 20%, what, more drop? Can you clarify? Silent alert. Demographic are changing. Millennials don't carry cash and most applications are completed online. Having monopoly on student loans, you are securing clients for next 30 years. This is the bullish case on SoFi. They're spending a lot of money on marketing, but they're targeting their marketing very clearly. It's millennials. Will it become the #1 app used by millennials? That's what they're trying to do. If they achieve, they're going to hit a huge demographic that is getting at a point in their life where they really use these services. They're at peak earnings. They're buying homes. They're having kids. They're refinancing. They're doing all of that stuff that SoFi can help them with in the future. That is the bull case. That is what SoFi is trying to achieve. I agree with that comment 100%. Hey, Sean, love SoFi and love good SPACs. Can you look into VORB for me? They just got a contract from NASA and GDPI Polestar. I will keep that in mind. I will do some due diligence offline to see more about VORB because I don't know off the top of my head. Steve Jones, SoFi could be profitable. Oops. Let me move this over here. SoFi could be profitable now, but they are putting big money in advertising and research and development. They will be profitable later this year or early next. The use of money now is smart long term. You are correct in marketing and advertising and research and development, but based on the projections, they will not be profitable this year or early next. I believe it's 2024 where they actually start posting a positive, and I think it's EBITDA, not net income. That's all for their SPAC projections, which we know SPAC projections can be completely out of whack, but I will give SoFi the benefit of the doubt because they have been beating projections, unlike many SPACs that went public and missed their projections in the first quarter of being a publicly traded company. What do you think about ChargePoint? Let's take a look at ChargePoint. ChargePoint is, I think, one of the better charging stocks out there, but it has been getting hit hard, and wow, there's just nothing left in this stock. We're heading back to the SPAC levels at $10. So for me, I have to do more research on this. Have there been any offerings on ChargePoint since they went public with the SPAC? We're past lockup, so that's done. Have any institutions been buying this? What are insiders doing? Are they adding to this? Because technicals right now are awful. This has to be a fundamental play, and I can't do that on camera. I need to take a look at revenues. I need to take a look at the valuation. I need to take a look at projections. I need to take a look at sector growth. But this is at a point right here, right now, where it's time to do that research. That's my opinion. So Av points, I'll take a look at that one off camera as well. Thoughts on SoFi institutional ownership. We talked about that on today's video. We went into the ownership. And in quarter four, we saw a lot of new positions. We saw a lot of companies add to it. I've seen videos talking about the short interest. There are some companies that do have put options. There are some institutions that are short SoFi. That short interest I'm keeping an eye on, but still it's not at a high enough value to really make a difference. Your opinion on DraftKings and Matterport. So Carlos Castellanos, DraftKings, FanDuel, Barstool Sportsbook, Caesars Entertainment, BetMGM. A lot of those companies right now, the way I look at it, and I did some extensive research on DraftKings versus FanDuel. If you FanDuel owns the largest market share, FanDuel is actually more of an attractive investment opportunity if you want to invest in that sector. They trade through an OTC stock. The ticker symbol is PDYPY. It's Flutter Entertainment. This company owns a bunch of sport betting companies over in England, and they also own 99% of FanDuel. And there is a case where they can spin off FanDuel and make it a publicly traded stock. But with investing in PDYPY, you get that FanDuel exposure plus all of their other businesses. So I think that's the better way to go. But honestly, I don't really like those stocks because it's very low margin. It's very competitive. If you take a look at all of them, they're just giving out so many promotions. It's hard for them to make money. And customer loyalty is very low. People will just transfer from one app to another based on promotions, based on boosts that they're getting. So it's not like you have just a one customer and they're only using your platform. A lot of people that I talk to, they have most of these apps downloaded on their phone, the ones that are approved in their state, and they're checking both of them to see which ones give the best promotions, which ones have the best boosts, which ones have the best lines. So it's a very difficult business. Of the companies, FanDuel is probably the best because they have the largest market share. But me personally, I made the decision not to invest in that space. Matterport, I know Josh Brown at the Reform Broker. He is the owner of the compound, is investing in Matterport. A lot of what Josh Brown buys, I like, but I'm not a huge fan of buying Matterport right now because I can't buy it and add it to my portfolio because I already have companies, too many companies that are trading on a price to sales multiple, and I think the whole metaverse hype will die down and we will see lower lows in Matterport. That's my opinion. American Battery, this is a interesting company. If you have room in your portfolio, this company deals with recycling lithium ion batteries. And if you take a look at all of the materials and raw materials that are needed for lithium ions and the amount of EVs that are going to be coming out in the future, there's going to be a huge business in recycling them. ABML could be a leader in that, but that's a very, very long-term play. If people keep buying calls, the market is going to keep tanking and taking your money if you are on margin. So people buying calls, it depends. Are you buying short-term out of the money calls? Are you buying long-term in the money calls and using those, which we call leaps, as a way to leverage your money and then selling poor man's covered calls against it? I never recommend buying calls that are short term and out of the money. It's pure gambling, and with this volatility, you're most likely going to lose your entire trade. You might hit on one or two, but it's just not worth it. So 10 to 20% more drop on the Nasdaq. You confirmed. Thank you. Your thoughts about semiconductor chip stocks, semiconductors, they're in everything. You just got to find the right company. Today I had horrible news on Intel. This is a value play. Value plays can be very tough because they're valued low for a reason, and that's because usually you need a turnaround story. But I think Intel can do it with their foundries. You have AMD, you have NVIDIA, you have Taiwan Semiconductor, you have Skyworks, you have Broadcom, Qualcomm. There's so many different chip stocks out there. Or you can just buy the ETF that has all of the chip stocks as well. So Carlos, he loves SoFi, $13.25 average. Thanks, EV Golem Volta opinion. I like ChargePoint better than those two. Do you like NMDM? Question mark. Thanks, bro. I do not like NMDM. I understand they have a bunch of cash on their balance sheet and there's a value proposition based on the stock price given how much cash they have. But the way they gathered this cash was just by selling and diluting their stock. I do not like management, and I do not like what they are doing with revenue growth. The company almost feels stagnant. They're doing these business acquisition. They're buying companies that have weird ties to the board. It seems a little fishy to me, and I don't want to invest in a company that seems fishy like that. You like SOS? I do not like SOS. I actually was short SOS. I don't like those kinds of companies. SOS had that short report come out, and things looked very suspect. Fubo TV, no. Buy Netflix, buy Disney. Why would I buy Fubo TV when the value is just it's so much more attractive buying the leader in what they do and like a Netflix that has dropped a ton. And we just saw Bill Ackman buy 3.1 million shares in that company to be one of the top 20 holders. Or Disney, which was the laggard of the Dow, is down a lot, has Disney Plus, has their parks when we reopen, is a company that's been around forever. I just like the risk to reward on those companies more. Energy, in my opinion, good to invest in next 3 months. So oil stocks, I would actually extend that out and say for the next 2 years. I think energy is going to be a good investment for the next couple years, in my opinion. Volatility, great to sell cover calls on SoFi right now. Also great cover call on the pumps. Yes, because if you don't know what this is, and hit that subscribe button, ring that bell, and smash that like button. Also join the Patreon to get access to the Discord server. These are the conversations that we're having. We are not buying short-term out of the money calls on anything. Whatever we're buying for the long term. We're buying leaps. Leaps are call options that expire at least a year, but I'm buying 2024. Call options that I have expire in 2 years, January 2024, and maybe I'll even roll them to 2025 in September when we get the new leaps. You buy them in the money so that you can sell poor man's covered calls against them. If you don't feel comfortable with that because that's a little bit more complicated, you can just buy 100 shares of the stock and sell a covered call. You're literally making money off of your position. Your position becomes an asset to you because it's bringing money to you depending on if you sell them every week, bi-weekly, or every month, every 3 weeks, whatever the case may be. You're turning your investment into a cash flowing property essentially. And if that investment goes up over time, you also reap the rewards of the increase in the stock. So it's a win-win. It's a very smart strategy, and it's a very It's what sophisticated investors are doing. They're selling covered calls. They're selling poor man's covered calls, or they're selling cash secured puts. They're using the options market to help them, but they're not being the buyers. They're being the sellers. They're being the writers of the contracts. Minus buying the leap to get your position started. You're selling options. You're selling options to the gamblers out there that barely make any money. Do you like Palantir? Palantir is very interesting. I'm torn with Palantir. I had cash secured puts on Palantir. The market dropped, and I decided not to take delivery of the shares and just take the loss on the cash secured put. Palantir is very interesting for me, and Palantir is a stock that like I want to get into. The prices right now are somewhat attractive to me. I've been waiting to get to these prices, but I Palantir is if I didn't own SoFi, I would own Palantir. I don't want to own them both. if I was to own Palantir, I would have to sell some of the other names. I would have to sell probably my Outlet and my Black Sky. Palantir is invested in Black Sky. But the thing with Palantir that I just do not like is I think we know what they're going to produce. It's pretty clear that they're going to have a consistent like 40% increase in revenue. You can do your calculations and find out what a fair price for Palantir is. The biggest question mark for Palantir is profitability, EBITDA. The company's been around for a very long time. It's a very competitive space. I don't fully understand what they do, and I don't think anybody can, because a lot of it is you just can't. It's government work. You're not. It's confidential. But the stock based compensation, the fact that the company's been around for, I think it's close to 20 years, they're still not profitable. I understand the path to profitability being on the private sector stuff, getting those people in and keeping them there. And I understand that Palantir has such a lead on its competitors for all the data that they collected and they harvest. And I really like Peter Thiel. It's just I haven't gotten there with Palantir yet. I've been watching it, I've been wanting it, but I haven't done it. And I'm happy that I haven't because the stock has fallen so much. If you watch Tom Nash, he is super bullish on Palantir. He thinks it's going to be $1 trillion company. He just released a video the other week where he said Palantir is over a 50% holding of his, and Palantir is down a ton. So he's lost a ton of money on this stock, but yet he's still bullish. Maybe I'll get there if Palantir, if we see a real flush in the market and Palantir drops, or I end up switching out positions. But Palantir isn't a no. It's not a yay for me either right now. I have a hard time with it, but I want to be in it. I am Jack Jesse. I just subbed. I love your videos and your attitude. Thank you so much, man. I really do appreciate it. I'm glad to have you aboard. I'm glad if I can provide any value to you. What should time period for safe long call options leaps? January 2023 expiry in the money. So personally, the further you go out, the better. You're going to pay more in premiums, and the deeper in the money, the better as well. Growth steer went so with leaps, you won't lose your entire position unless it's below the strike. So if you take a look, we'll do this real quick. So if you take a look at SoFi and you go to the trade and you look at the options, right? So I have the January 2024 options at the $7.50 strike. So I'm pretty deep in the money, but I could be even deeper. The deeper you are in the money, the less risk there is to you. I don't lose all of the money I put in unless SoFi is below $7.50 by January 2024, 2 years out. And I can always roll these, I can change the strike price, I can trade it. But when you take let's for example, in Thinkorswim, you can right click, you can analyze buy trade, analyze single. So then you can come over here and you can hit risk profile. It's going to show you your position. So here's your risk profile for that leap, right? So come on, what is? So we were sorry, I'm getting confused. We were looking at the $10 strike. Come on now. God damn it. So let's go back. I'm sorry, I'm getting confused. Here we go. So we're looking at the January 2024 $10 strike. The premium $5.95, right? So our break even is $10 plus what we paid, $5.95. So our break even stock price for Palantir is $15.95. It's a $10 strike. If Palantir is below our break even, higher than our strike price, we don't lose all of our money. We lose some money. And you can see how it's going down. So if Palantir was $13, we would lose around $300 on that trade. It doesn't go to zero until we hit that $10 strike. But we also have a lot of potential reward. So, and it goes up and up and up. So long story short, when you're looking at buying leaps, it depends on how much money you can pay and how much leverage you're looking for. So if you were to pay $927 for the $2.5 strike, your break even is basically going to be at the stock price. You're not going to lose all of your investment unless SoFi is under $2.50. So this is obviously the less risky play, but you're paying $927 to exposure of 100 shares. The closer you get to in the money, or the further out of the money you get, you're paying less for exposure to 100 shares. So you're leveraging your money more. It all depends on what you're comfortable with and what your portfolio allows you to do. But generally, the further out in expiration you are and the deeper in the money you are, the better. So let's so Mazda Miata, I know you're a huge SoFi bull. Thank you for joining in this video. And you're not worried about SoFi. You keep on buying it. Leaps, baby. Leaps, leaps, leaps all the way. Also, this dips are good to sell puts. Long premiums insane on SoFi. Yes, if you are bullish on SoFi and you have a price, you can sell a cash security and take delivery of those shares. Palantir is going to be the next IBM. Thanks for your time, Sean. Bless you. Thank you so much for your time. Would you disclose your position in SoFi? I'm 840 shares at $12.81, thinking of continuing to buy until it hits the bottom. My position on SoFi is I own 3 leaps of the $7.5 strike for the expiration of January 2024. It's around $3,000 worth, so not a huge position. Blade Air Mobility, it's another SPAC. I don't really like them. Start a small position in Palantir. We had a long discussion about that. Great position. Congrats. I pick Robinhood over SoFi. Man, that must have hurt because Robinhood is tanking. And I think it's probably going to drop even more. Okay, left in my Robinhood account. Or do you mean you pick Robinhood over SoFi for trading? Robinhood is a start, but it's once you learn how to buy and sell stocks, there's way better platforms out there. $10x by January. Company that can 10x, but I know some positions that might 10x. One position of mine that I was up around 800% in were Ford leaps when Ford was at $25. I think that position will 10x by the end of the year when we have the launch of the F-150 Lightning. We also have the e-Transit van news, and we Ford sell their Rivian stake, collect $1 billion off of that investment, and use it to make even more EVs. So I think my position will 10x in Ford. Kind of nervous why SoFi pushed back the earnings call to March 1st. I really don't know why. Maybe there's some news that they want to include. Actually, I think I know. It's because of that banking charter, and they want to deliver news on March 1st that the banking charter, they want to give you a definitive date on when that's going to take impact and when that's going to take effect. And you're actually going to see it in the financials. SoFi is a monster in the making, in my opinion. I hope so, Hard Knocks. I hope so. Bank acquisition is closing on February. They want to put a better guidance. Oh, there you go. See, I agree with that. We're on the same page. I wish I knew how to do call and options, etc. I'm a noob and just been investing 1 year. I hear a lot of stories of people getting wrecked. I can buy shares for now. Yes, so you know, just like buying stock, Option market is very diverse, and you can be reckless with purchases. You can buy out of the money call options that have very low probability and you can get wrecked, or you can sell options, take a little bit more approach. The option market is great because it allows you to be the casino instead of the gambler. It allows you to sell options to the gambler, so you can be the house with options. You can sell them. So what makes options so cool? Could you please describe poor man's covered call? So I, I can. So essentially and I'll make a video on this in more detail. But a poor man's covered call is essentially what is a covered call? A covered call is when you have 100 shares of a stock and you sell a call option against it. Let's say you have 100 shares of Sofi at $11. So you're $1,100 in. You can sell covered calls against that position. You can sell calls for the $15 strike, for the $20 strike, whatever. And you can collect that money. If SoFi was to get to $15 at expiration date, you would have to sell your 100 shares at $15. So that's a $4 gain, plus you get to keep the money you get for selling that covered call. A poor man's covered call works instead of owning 100 shares, you own one of these leaps that are in the money and have a relatively high delta. Delta is the change in the option premium for every dollar increase in the stock. So if you have a 0.9% delta or 0.9 delta, your option premium is going to go up 90 cents per dollar that this increases. So if you have a covered call that's in the money and a leap, you can sell shorter term calls against it. These are poor man's covered calls. Let's say you have the 7.5 strike and you're selling covered calls at the $15 strike. So $7.50 difference. You're going to make money on the upside. You're going to make 90% of it just about. The delta will increase as the stock price gets further and further in the money. But essentially, what you do is instead of selling those 100 shares, you sell that leap option, and then so when the covered call expires in the money, you're going to have a ton of gains from your leap option. You could sell it, buy 100 shares, and give it to the person and collect the difference. You just have to put less money up front to sell covered calls against it. What background music? What background music was playing? Yeah, yeah, it's what the hell was going on there? What music was playing? Yeah, I know. There's a delay in the chat too, and you guys are yelling at me. What music was playing? I don't know. I was talking to the Lord. Lord, covered calls, poor man's covered calls. Disco Land. Damn, dude. I watched that to see what music was playing. Where the hell did the music come from? Uh, could somebody let me know where the music was playing? Margarita nights in the house. Yes. Hold on. Screw this. Screw the music. I don't know where I left off with the poor man's covered calls, but essentially, covered call, you buy 100 shares, you sell a call against it. If the stock goes up, Gangsta Mexican Rasta. Yeah, it's probably it's probably something that I was banging to earlier in the day. Um, so a covered call, you buy 100 shares, you sell a call against it. If the stock goes up, you just have to. So you buy 100 shares at a SoFi at $11. You sell a $15 covered call against it. If the stock gets $15 by expiration date, you're sitting on a $4 stock price difference. You collect those, you sell it for $15. The downside on a covered call is if SoFi was to go to $17, $20, well, you're obligated to sell it at 15. So you don't lose money, but you can miss out on some gains. That's a covered call. A poor man's covered call is instead of buying 100 shares of a stock, you're buying a leap option that's in the money. And essentially, with that leap option, that value of that contract is going to go up as the stock price does. You're not going to collect on 100% of those gains. It depends on what delta is for the contract. If delta is 90 for the leap option, then you're going to collect 90% of those gains. So you're still going to make money, but you might make less, a little bit less money than selling a covered call. The reason why it's called a poor man's covered call is because it requires less capital up front. To get one leap, it might cost you $900 versus buying 100 shares at 1100 bucks. So you save some money, but you still collect the same in premiums. So you're actually making more money by selling those calls if they do not expire. So if you sell them at prices that the stock does not hit and you just continue to collect those premiums, you're making more money off less money. You're returning more money. Your yield is higher on a poor man's covered call. And that's why I personally use it. And also, of leaps because you leverage your money and you collect more money on the upside too over the long term. And one thing I did not mention, and Dakota is talking about this, stock market is about managing downside. When you have a position and you use options world to collect money monthly, weekly, or whatever the case may be by selling options, that's essentially managing your downside because you're hedging your position. You're making money off of your position while it stays flat or goes down. So you're making some money, so then therefore your break even is going to be even lower. Let's say you bought some leaps on SoFi and the stock was $11 and it dropped to $9, but you were selling calls and you made 200 bucks. Well, now the amount of money that you lost is less because you were making money off covered calls. You were hedging in a way. So how often do I run into theta decay before rolling over? So if you're talking about my short-term covered call, today I just sold a couple and basically they were worth essentially only one was a penny and the other was 2 pennies, because the contract was about to expire. You had a bunch of theta decay, so I was able just to over my covered call to the next month or just close out of the position. For theta on my leaps, because they're so far out, they're in the money. There is no theta decay for the leaps. And every time I get to a leap that's about to expire or I'm very uncomfortable with the position, I roll them to the next year to try to stay away from theta decay. So before we sign off, just because I'm going to want to do this before heading to bed, it's 10 p.m. here. I've been on for almost an hour. I was on for just a couple of minutes, like half an hour. I want to take a look at the Nasdaq futures. Apple had earnings. So if you didn't see, they did really well on the print. The stock moved higher. We also saw Microsoft yesterday. They had earnings. The stock dropped off of the print, but then guidance came in and it actually moved higher. Then we also had the Fed meeting yesterday. So I think we got a lot of stuff out of the way and we might be able to move forward. Take a look at the futures for the MNQ and we actually take a look at what's happening here. So futures have bounced a little bit in after hours. So here is the close right here. Here's 4 p.m. and we did bounce a little bit. that bounce right there is because of Apple. Let's see what's going on with Apple here. God, I keep on forgetting. Here's Apple. Let me go back. Sorry. I'm still learning about this live stream stuff. So bear with me for a second. So back to the MNQ, which is the Nasdaq 100 mini futures. If we take a look, here is 4 p.m. Then Apple had earnings. We saw that little bump here, and we're trying to break that high in the futures. So not a huge bump. Let's see what's happening with Apple. So here's your pop in Apple. It's kind of doing what the futures are doing. Apple is a huge weighting in the Nasdaq, so we'll see what happens with that stock. But I think having good earnings in Apple, having good earnings in Microsoft, I think we can look forward past that in a little bit for the Nasdaq, and we can try to reclaim some of those highs again and not retest that low that we saw on Monday. Apple saved the markets. So Apple, Microsoft, we still have Google, we still have Facebook, Amazon. There's still some stocks out there, but Microsoft and Apple definitely, I think, took some fear out of the markets. Yo, so we had AAII sentiment today, 23% bullish, 23% neutral, 54% bearish. So we actually went up on the bullish. If none of you guys know, and I promise I'm going to get off after this, what the AAII investor sentiment is, and I made a video about this and how this is a contrarian signal that we're getting close to the low. So Barrett, wow. So if you don't know what this is the American Association of Individual Investors, and here are your sentiment votes. So we just got the next round of data today for the week ending January 26th. So bullish sentiment's 23%, neutral sentiment's 23%, bearish sentiment is 53%. Now, the signal, the contrarian signal that's, according to Tom Lee, 3 months out, we're going to see higher highs, is when the difference between bullish and bearish is more than 20%, and when bullish is under 25%. So we had a slight uptick in bullish sentiment, but we had a huge uptick in bearish sentiment and neutral decrease. So the way that I look at this is, if this is still the contrarian signal, bearish is getting even higher. The higher bearish we get, the better, in my opinion, because the theory behind this is when you have so much bearish sentiment out there, typically what happens is those people already sold. They're bearish on the market, so they take their money out. They're not invested in it. And this allows good news to be good news. And then when you see the stocks go higher, the bearish people have to buy in and they move it up even more. So having people out of the market allows good news to be good news, and it also provides room for more buyers because you took them out of the market. They're going to come back in if you see good news and you see stocks move up. So it's actually a contrarian signal, and we went over the data. We went back all the way to 1999, and all of the cases where this happened, only 3 times did it not work out. It didn't work out in 2018 or 2008, and there were a few other cases where it didn't work out, but the majority of the time, when you had this contrarian signal 6 months out, the stock market was on a rally. We were much higher. So this is a contrarian signal for investors. And I'm just happy to see that more people are bearish. More people are bearish, less people, they're already out of the market most of the time. And then they can buy in when we get good news. And that's a way we can see a market rally. So guys, I appreciate all of the comments. I've been on this for a little bit too long. Before I sign off, hit that subscribe button, ring that bell, smash that like button. Also be aware that this channel does have a Patreon. Get access to a private Discord server. You can get access to valuation spreadsheets, to meetups. You can help support the channel. Also know that there are super chats down below if you want to help support the channel as well. I'm going to be doing more live streams. I'm not going to be focused ad revenue anymore. I'm talking about stocks that do not get attention because there are plays that make people money. Just today, I got a notification from someone on the Patreon that they bought puts on Lucid. This was a call out that we had on the Patreon. They made $1,800. It covered their subscription many years out, 20 years, because I only charge $5 a month, and they appreciate it. But yet, when I made that video on YouTube, my subscription actually dropped because I talked negative about a stock. So I'm over the algorithm. I'm just going to be doing live streams. I'm going to be talking about investment strategies, and I appreciate your support. So if you can join the Patreon, super appreciate it. On the next video. It's been real. It's been fun. It's been real fun. We are investing, and together we are invincible. See ya.